Hello, learners. Welcome back to our session today. I am instructor CP Ringo Frederick, and it is a continuation of what we were doing earlier on. Remember, we have introduced the concept. We had introduced the concept of a capital asset pricing model. We talked of the aspect of a arbitrage pricing model. Class today, it is a very interesting session because we are going to introduce a very interesting model, which we normally refer to it as a Fama-French model, and Pastor-Stambaugh model, right? These are very interesting models when it comes to aspect of us analyzing our investments, and that's what I want us to do today. So just as I've mentioned, remember previous classes we had talked of the concept of capital asset pricing model, right? Where we mentioned that this portfolio, basically the whole concept here is that we're looking at portfolio that are affected by systematic risk alone. That is one item that we must always tend to have in mind. And in addition to that case, we also mentioned that basically at this point, the investor holds a portfolio which is fully diversified. In essence, that is the only prevailing risk is systematic risk, which is measured using a beta factor, Also, another assumption that we had also talked about in our previous class in relation to this is that all investors basically all the investors, of course, in the market can borrow and lend out any amount of money at the risk-free rate. Also, there are key item we mentioned that for CAPM, ideally, we normally tend to look at a single factor model, right? This is just some of the concepts that we are looking at. This is a single factor model. I just want to give you basically this journey up to what I want us to study today. So in addition to that, we also went ahead and talked about the arbitrage pricing theory or arbitrage pricing model, where we mentioned that the whole concept of arbitrage pricing theory, the whole premise, it is on a capital asset pricing model. So at this point, we are looking at multi-factor model, right? We will not only consider one factor that will affect our returns in the market, but rather we'll be talking of various factors which will have an impact over expected returns. And this is what we talked about, the aspect to do with arbitrage pricing theory, which we refer to it as a multiple factor model. I know you'll wonder, why is Mwalimu giving us all these items that we mentioned, right? This is important because when we'll be looking at now the Fama-French model, when we'll be talking about the Fama-French model, if I were to start with this, Fama-French model, you'll find that this is simply an extension of capital asset pricing model, right? This is number one, we must be able to understand that at this point, I'm simply looking at an extension of capital asset pricing model. That is one thing that we should be able to understand anytime you're talking about the Fama-French model. I know you'd be like, Mwalimu, do you also have a Fama in or rather, do you also have a Fama in financial management? Yes. You'll find that basically this aspect of the Fama-French model, it was developed by two basically interesting persons when it comes to matters to do with financial management, right? And these guys basically, of course, if at all you can all remember about this person that you might refer to as Eugene Fama and Kenneth French, right? Eugene Fama and Kenneth French. These are the two guys basically who came up with this model. And they are very interesting in a way, like they wanted to develop a model which will simply assist us as maybe aspect of analysts to be able to, number one, basically determine the, or rather to price our assets in the market, as well as also doing this investment analysis. So you'll find that these two gentlemen came up with this model, which they refer to it as the Fama-French model, of course, from their names. Okay, so on this case, my good students will find that this model, compare it with the CAPM, this model considers three factors. three factors. So we normally refer to this model as what? Three factors model, right? Three factor model. And the factors that this model normally consider, we are going to mention them, which number one, we normally tend to talk of number one factor, which we normally refer to it as what? The market risk. Number one, we normally tend to talk about market risk, which ideally at this point you're talking about what? The market factor being on number one. Market factor. Okay. So anytime you're to talk of market factor, my good students, what must we be able to have in mind, or what must we be able to recall or understand? That's another important question that we should always tend to ask ourselves. So you'll find that for market risk, or rather the market factor, you'll find that it is similar to the beta in the KPM, because at this point it simply measures the excess return of the overall market. That is, it's like, remember the risk premium, right? Recall risk premium, what we had looked at this in capital asset pricing model, where the risk premium, ideally, we are looking at what? The return of the market minus what? Minus risk-free. So you'll find that at this point, ideally, we are looking at the excess. We are looking at the excess return of the overall market. It measures excess return of the overall market. So this is very ideal and very important to note. Like whenever we are talking of this factor, which you're referring to as the market risk, or rather the market factor, you'll find that it measures the excess return of the overall market. Very important to understand. It's all about aspect of systematic risk, right? Number two factor here that you must also consider is what we normally refer to as the size factor. Size factor. And Mwalimu is going to explain the size factor here. You'll find that size factor, ideally, we normally tend to talk about basically S and B, right? We normally tend to talk about the concept of S and B. I know you'll wonder, Mwalimu, now, what are all these that you're telling us? You'll find that this is a very simple concept, because anytime you're talking of S and B, simply, we are looking at small minus big. Small minus big. Small minus big. These are what you're referring to as the S and B. Small minus big. It's getting interesting, right? We're going to jump deep onto that and explain it further so that you guys should be able to understand it clearly. You'll find that the size factor is simply, you'll find that for the historical outperformance of small stocks over large cap stocks, in this case, it accounts basically for that, right? We're looking at it as a factor that accounts for the historical outperformance of small stocks over large cap stocks. Ideally, you'll find that this factor normally suggests that smaller companies, they normally tend to have higher expected returns than bigger companies. That is what this model suggests, that smaller companies tend to have what? Tend to have basically what? Higher returns. So that is what you're referring to as size factor model. Small minus big. The third factor here, we normally tend to look at this factor, which we normally refer to as the value factor. Value factor. At times, you'll also find that some books will also refer to it as what? HML. HML. And what does this stand for? This stands basically for what we normally refer to as basically high minus low. HML. This is high minus low. That's why you're referring to it as what? As HML. So you'll find that under this factor, my good students, you'll find that it considers the historical outperformance of value stocks compared to growth stocks. Simply, you'll find that this factor implies that value stocks, which are considered undervalued by traditional basically valuation metrics, tend to have what? Tend to have higher returns the aspect of the undervalued stocks. Recall when we were looking at it, remember the concept of alpha, right? Alpha, like for Kapemo, we are considering basically the return of the security or portfolio minus, of course, what? The aspect of the CAPEM or SML line, right? Where in this case, you are talking about the efficient, inefficient, and super efficient. If at all you can recall, we had looked at this concept, right? So you'll find that when you're talking about the Fama-French model, ideally, it considers these three factors. These are the three factors that basically it is going to consider at any given point whenever you want to determine the returns. Digest that, it is very important. So that after this, my good students, it is important to be able to understand that therefore, anytime we are talking of this model, for us to determine, of course, the return, of our security or portfolio in this case, I'll be considering these three factors. Of course, we'll be talking of the aspect to do with our treasury bills, which are simply our risk-free, right? Or if at all, we can use it in this case. Remember what we did, talk about what? Treasury bills. So I'm having basically here our treasury bills. Okay. In this case, you are going to add, of course, the sensitivity to equity market factor times the equity risk premium. Sensitivity to equity. Sensitivity to basically, this is, of course, sensitivity to equity, market factor, sensitivity to equity market factor. Okay, we are going to multiply by the equity risk premium. And at this point, remember the sensitivity. In this case, it is measured by what? It is measured by beta. So it's like you're talking about what? The beta of the market, right? Times the risk premium. And remember, risk premium is return of the market minus our risk-free. So all these are first factor, right? Term it as factor number one. Factor number two, my good students, we are talking of sensitivity to size of sensitivity, basically to size factor. Sensitivity to size factor, right? To size factor. We multiply by, of course, our size risk premium. Size risk premium here. Size risk premium. Okay? So that as at the end of the day, we're also going to add our third factor here, which is a sensitivity to value factor. Sensitivity to value factor. Sensitivity to value factor. We multiply by the value risk premium. Value risk premium. Recall this, right? So this is how we can determine our return of our security. Basically what? Using what? Using the Fama-French model. I'm going to simplify this concept so that it will be very easy for us to be able to understand. Okay? So take this case in a very, very easy manner. You shouldn't be stressed with all these terms, right? So this is like saying we are talking of for us to basically determine our return, right? It's as if you're talking about our risk-free, which is basically measured by treasury bills, right? We add the beta of the market, which is BM. We multiply by the equity risk premium. So this is what? Aspect of return of the market minus our risk-free. right? Return of the market minus our risk-free. That is what will give us our risk premium. Then, in addition to that, of course, you're going to take this other component whereby we are going to add, right? We are going to add sensitivity to size factor. That is, of course, the beta of our size factor. We multiply, of course, by the size risk premium, which ideally here we are talking of what? SMBM. SMBM. Okay? Then we are going to add this component, which is sensitivity to value factor. So basically, I'm having the beta of our value factor. We multiply by the value risk premium, which is what? HML. So I'll be having by HML factor. You see? So having this, these are what will give us basically what? The return of the market, or the return of the security that you are looking at. So that is as simple as that, and it is very vital for us to be able to understand this concept very clearly. Take your time, whereby you'll find that whatever that Mwalimu has given us below, it is simply to make sure that we are very good. We are very good when it comes to these aspects or item. So this is all about aspect of the Fama-French model. The main item that we need to basically understand is this concept here. Okay? So after we are done with that case, I'm going to combine it with this other model, which you are referring to as the Pastor. Talk about Pastor-Stambaugh. Right? Pastor-Stambaugh model. A very interesting model. A very, very interesting model that you guys, you should always be very interested with it, because as at the end of the day, it more relates to what we've just done right now. So you'll find that when you are talking about the Pastor-Stambaugh model, of course, these are an extension. These are an extension of what? These are simply an extension of Fama-French model. This is simply an extension of Fama-French model. This is simply an extension of Fama-French model. Because we have talked of what Fama-French model entails, so you'll find that simply these are literally an extension of that. And of course, this was developed by these two important guys, that is Lubos Pastor and Robert Stambaugh, right? Lubos, right? Lubos Pastor and Robert Stambaugh. These are the guys who are basically, of course, economists, and at the same time, basically, you find that they were very interesting. They are very interested whenever it comes to matters to do with securities, right? And of course, aspect to do with basically investments. So, in addition to basically all these other factors that we were looking at under Fama-French model, you'll find that basically these two gentlemen, in this case, you'll find that they suggest that stocks with lower liquidity tend to have what? Higher expected returns. They suggested that the stocks with lower liquidity, they normally tend to have what? They normally tend to have the higher returns, high expected returns, of course, to compensate the investors for the added risk of the trading in less liquid assets. So you'll find that the concept that these two gentlemen introduced, and their main contribution actually was in relation to, their main contributions actually was in relation to what? The liquidity risk and expected, this is of course the liquidity risk, and expected stock returns, and expected stock returns, right? So this is the main concept that basically these two gentlemen introduced, more so the aspect of what? Liquidity risk. So they suggested that at this point, for us to determine the return of our security or of our market here, or rather of our portfolio, we should be having the aspect to do with the same concept, which we are talking of an extension of Fama-French, whereby I'll be having risk-free into beta of the market, risk premium of the market, that is of course return of the market minus risk-free. In this case, of course, we add the beta of the size of the market, S and B, right? Small minus big. In this case, we take the third factor here, which is of course the value, so beta of the value factor times HML. So whatever that you are going to introduce here, my good students, now it is a liquidity factor. Now it is the liquidity factor that we are going to introduce in this context. So in this case, we'll be having, of course, the sensitivity to equity market factor. That is sensitivity plus sensitivity to equity, sensitivity, of course, to liquidity factor, sensitivity to liquidity factor. We multiply by the risk. We multiply, of course, by the risk premium. Talk about, of course, the liquidity risk premium here. Liquidity risk premium. Liquidity risk premium, right? So that's the factor that we are going to introduce. So here we'll be talking of the beta of liquidity. We multiply by the aspect of what? By the liquidity now. Liquidity. Use LIQ. So these are what you should be having. So you'll find that these two models basically nowadays, they are very common when it comes to financial management, and they are very much applicable. They are very, very much applicable. So now, because we are having a clear concept on that, I want us to look at this question, which was simply tested back in, of course, this question was tested in, that should be August, or rather November 2020. I know majority of the students, they literally had kind of a difficulty on this question, but you'll find that it is a very, very easy question. It is a very, very easy question. So these are questions that I've literally shared with us there. And I believe that it is very visible. I believe it is very visible. So I want us to basically use this question to be able to understand and summarize the whole of this concept to do with these two models, the Fama-French model and Pastor-Stambaugh model. Very important that we should be able to understand that. So this is a November 2020 question number 2. So allow me to basically have it down there, which I believe it would be very visible, right? Then just have it somewhere there. So that is November 2020 question number 2, specifically part B. So because now we have understood this concept, let us now cement that knowledge with this question of ours here. So what are we told in this question? In this question, my good students, you are told that I'm having this company, the estimated factor sensitivities of Diamond Limited to Fama-French factors and the Pastor-Stambaugh model factors, and the risk premium associated with those factors are given in the table below. Market factor, size factor, value factor, liquidity factor, the treasury bill rate I'm given at the rate of 5%. Okay? Look at the question here. Number 1, the required rate using the Fama-French model, 3 marks. Number 2, the required rate of return using Pastor-Stambaugh model, PSM. I'm given another 3 marks. So literally, these are like 6 marks that a good examiner is giving us for free. These are like 6 marks that a good examiner is literally giving us for free. So the first thing that must always tend to come at the back of your mind, my good students, is how to determine the first component, Fama-French model, right? Which at this point, they want us to determine, of course, the required rate of return. So at this point, I should be able to recall this formula of ours. You see this one? This is a Fama-French, right? This is a Fama-French. We're talking about it. Fama-French. So immediately show your examiner that you know what you're doing by putting this model on your paper. So the moment I have this model, very well, I can be able to come and determine our return very easily. So that in this case, my return, we should be having the risk-free. The risk-free there, according to our question, a good examiner has given us what? You can see it is 5%, right? That is a 5%. So I'll basically be having my 5 there. We are going to add what? We are going to add the component of the beta of the market and the risk premium of the market. Were we given those factors in our question, my good students? I can clearly see that we were given the market factor sensitivity is 1.05. So I'm having 1.05 times basically the risk premium, which I'm given 5. We add what? Beta of the size factor, right? Beta of the size factor, and I'm having what? The risk premium of the factor, which in this case, the size factor, I can clearly see I was given the beta to be negative 0.65. Look at the size factor. Look at the size factor. I'm given what? I'm given basically minus 0.65. We multiply by the risk premium, which was given 2.50. Right? Then we add what? We add the beta of the value factor, which was given negative 0.20. Negative 0.20. We multiply by the premium, which was given what? 4.50. 4.50. As simple as that, which in this case you should be having what? Take your calculator and work it out for Mwalimu very, very quickly. If I take my calculator here, I'll be having 5 plus into bracket 1.05 times 5. We add negative 0.65. We multiply by 2.50. Of course, we add negative 0.20 times 4.50. In this case, it should give us what? Of course, I'm having 7.725. Kindly confirm if you're getting the same value with Mwalimu. I'm having 7.725. So I'll be having here 7.725%, of course. Using the first model, which was the Fama-French model, right? Fama-French model, okay? You have your 3 marks. We proceed to number 2 model, which in this case is what? Pastor-Stambaugh model. And once I know, or rather once I've seen Pastor-Stambaugh model, the only factor that I'm going to add is the liquidity factor. The only additional item that you'll be adding is simply the liquidity factor. And that is to say that would be quite easy now, because already my return here using basically this using this Pastor-Stambaugh, right? Pastor-Stambaugh model, right? I'm having what? I'm having already 7.725, right? We are going to add, of course, the beta of the liquidity here, which of course is basically that risk component, which in this case a good examiner has given us there. Look at it. For liquidity factor, I'm given the factor sensitivity is 0.20 times the premium. I'm given risk premium, which is 4.50. That is the only thing that you're going to add. So that as at the end of the day, my good students here, what will you be having? I'll just take, of course, that component. Therefore, you should be having 0.20 times 4.50 plus 7.725, whatever that you had already computed. So I'm having what? 8.625%, right? Pastor-Stambaugh model. So is there any difficulty with these two models? You've all been hearing aspects of Pastor-Stambaugh model. You've all been hearing Fama-French model. Is there any difficulty in that concept? Mwalimu has clearly tried to give us the whole concept of these two, so that by the time you're through this video, I'm very sure there's no question if you literally understood the whole concept. There's no question which might come in relation to that and you find the challenge of the same. So basically that is what you're required to do. So that is to say, literally, we are now done with the aspect of portfolio analysis. We've now literally looked at everything in relation to portfolio analysis. So to this point, guys, thank you so much. And let us meet in our next session where we are going now to introduce other concepts. Thank you so much. And let us meet in the next session. Bye-bye.